Have you ever borrowed money and wondered why the interest on your loan ends up being more than expected? Let's dive into APRA versus APY, a difference that can cost you big bucks. First, let's define APRA, which stands for Annual Percentage Rate. It shows the interest rate over 1 year without considering compounding. Now, APY, or Annual Percentage Yield, takes into account compound interest, which means you pay interest on both the principal and accumulated interest over time. Think of APRA as a flat fee for borrowing money. But with APY, it's like adding more ingredients to your recipe every day. The end result is bigger than just the sum of its parts. A common misconception is that APRA and APY are interchangeable, but they're not. Let's see why with a $100 loan example. If you take out a $100 loan at 5% APRA, by the end of 1 year without compounding, you'd owe about $105. But if it's compounded monthly APY, that same 5% rate can cost you more like $105.12. Why does this matter? Let's say your credit card has a 12% APRA but compounds monthly, so it's really an APY of around 12.68%. That can add up if you don't pay off the balance in full each month. Remember, always check the fine print to see whether your loan or savings account uses APRA or APY. It could mean hundreds of dollars over time. Stay informed, but remember this is general educational information. Consult a financial advisor for personalized advice. And if you found this useful, hit that subscribe button.